Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to calculating cost of goods sold using both the last in, first out method and the first in, first out method, otherwise known as the LIFO method or the FIFO method. Get ready, it's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that information into the blue area into our worksheet on the right-hand side using both the first in, first out up top and the LIFO last in, first out methods. The information on the left is the beginning inventory of the 780, the cost per unit of that beginning inventory, $10. Units produced in the current month, 1,200, and the cost per unit, $12. Units sold is going to be the $1,800. Now remember, when we're thinking about the units that we're producing and selling, we're thinking about units of inventory that are typically all the same. They're not custom units. They're going to be some types of things that are all the same. Therefore, we're not going to allocate a cost to each individual unit, but use some type of flow assumption. Most common flow assumptions, first in, first out, last in, first out, average method. First in, first out is typically more intuitive. I think it would be used by far more than last in, first out, but it's good to know them both because they contrast each other well and they emphasize the fact that we're using basically flow assumptions, and the flow assumptions we use will have an effect on the financial statements. Now, when we think about the flow assumptions, typically the cost of the units, whether we buy units, mark them up and resell them, or make the units, will typically go up in price, meaning you could see that they cost more over time. That's because of inflation typically, meaning value of the dollar will go down, therefore the cost of units that we produce or materials to produce them will typically go up. So normally, I would normally think of it as this. It doesn't have to go up, but you want to think of, in normal conditions, the price of your inventory that you're buying or making will typically increase. Understand the effect of first in, first out, and last in, first out on the financial statements under normal conditions, and then flip that understanding, reverse it, if you're in unusual circumstances, in which case the cost of the units go down, which could happen, of course, because it could be cheaper, for some input units might be cheaper for whatever reason in the economy, and then the cost could go down. And then you want to take your assumptions that you're thinking about for the effect on the financial statements under the normal condition and basically reverse them. So let's work through this and see what we're talking about. So let's do the first in, first out, because I think that's going to be the method that will be far more greatly used, make more sense to most people as well. So we're going to say first in, first out. We're assuming the units that we have first are the first ones we sold. We're going to break this out into 3 columns. The production, or the purchases if we were to purchase, or the items we're going to produce. Then the sales, meaning the units that we sold, not in terms of sales dollars, but to calculate the cost of goods sold, the cost of the units we're selling. And then we have the ending inventory. So remember, they might ask us for cost of goods sold if we're looking at a book problem, cost of goods sold, or ending inventory. You can kind of set up worksheets to figure this out, but you want to standardize your worksheet so that if you go into a test question, you can just simply write down one worksheet whenever being asked a cost flow type of assumption. So this is kind of a long worksheet, but it's standardized, and it'll help you to kind of figure out one worksheet for any circumstance you're in. If you want to then take that and shorten it down for test taking purposes, you can then do so. So we're going to say, all right, the units that we started with are going to be the 780. And just note the structure of this. We got 3 sections and then the same groupings under the 3 sections. So the purchases of the stuff we're making, the units we're selling to calculate the cost of goods sold, and then ending inventory. Okay, so we're going to start off with the 780 times the $10 per unit, multiplying that out, 780 times the $10. That's going to give us our 7,800. Then during the period, we made more units, which means we're going to say we produced during the current period 1,200 units, 1,200 at $12 per unit. So the price went up. That's kind of normal. And then we're going to say that would be normal circumstances. I would keep that in your mind as being what you would kind of expect. If it does the opposite, then you're going to say, okay, that's in your mind, I would think of that as the opposite of the norm, right? And then flip your thinking from the norm to reverse it. So I'm going to sum these up. That means we have total units then over the period of the 1,980 that could have been sold. So if we sum up this side and underline here, we're going to say that's what could have been sold. And then we sold units that will be the 1,800 units. Now, under the first in, first out method, we're going to assume we sold the first units that we had. So the units that were already on hand are the ones that we assume that we actually sold. And that would be what we would like to do under a normal flow through assumption normally, right? Especially if you're imagining something that's going to be expires in some time or whatnot, you want to sell the older units first. You can imagine that to be the case. Those will typically be the cheaper units because that they usually were done if there was a price change. The price typically will go up. So the ones we're selling typically are going to be the cheaper units. If you think about that in terms of the income statement, that means we're the cost of goods sold, the expense is going to be less than it would have if we picked up the $12 units, right? So we're going to say, all right, we're selling these units, which are going to be the 780. I'm going to clear them out. We sold all of those. This equals the 780 times 10. And then we need to get up to 1,800 units. So I'm going to say this equals the 1,800 units minus the 780. That means we sold 1,020 of the 1,200 because that's how much we needed to get up to the total of 1,800 units total sold. So we sold that many, 1,020, that we're assuming at the $12. And so if we multiply these out, there we have it. Let's sum up this side equals the sum of these two. Put an underline here, home tab font group, and underline. And then we'll put an underline over here. We'll sum these up. That's our total cost of goods sold under the first in, first out method. So they might ask us for this number, and then they might ask us what is left in ending inventory. So what is left in ending inventory? Well, the first beginning inventory units have now been wiped out. So it would be this number minus this number at the $10 have now been wiped out and are now zero. 0 times 10 is 0. And then of these units, we have, this will be equal to the 1,200 minus the 1,020. At the $12 units, we have left over then the 180 times $12 or $2,160 worth of inventory. So units then left in ending inventory, summing these up, 180, underline, home tab font group, underline, summing up the outer column equals the sum of these items, underlining, home tab font group, underline. All right, let's do the same thing under the first in, first out. Now the first in, first out, this side is going to be the same because we're talking about, all right, we're going to still assume the beginning inventory is the 780. Again, in practice, it may not be, right? I mean, if you were running LIFO, we're doing LIFO now, last in, first out. Now, if you were running last in, first out for multiple months, you probably wouldn't have the same beginning number as with first in, first out. But we're going to start at that beginning starting point and compare the two methods from this point forward. So we're going to say we have the same 780 to start with here. So the 780, and if we multiply this out, the 780 times the 10, and then we have the items we produced in the current month, which is the same. We're saying that we produced another 1,200 at $12, multiplying this out, the 1,002 times the 12, that's going to give us our total, which we're going to say equals the sum of these two. Putting an underline here, home tab font group underline, and the sum of these two. And putting an underline here, home tab font group underline. Now when we think about the sales, we still sold 1,800 units. However, now we're going to be selling these units first. Now this is unnatural in your thinking. If you've ever stocked shelves or anything, you're going to say, well, that's not what we would like to happen under a normal flow. Notice that the flow assumption does not have to follow what actually happens in real life. It's an assumption because all the units are the same. We don't know which ones were sold, in other words. So we can assume anything we want. If we want a last in, first out assumption, we're going to assume the last ones were sold first. Why would we do that? Well, one reason is that notice what will happen when we do that. Under normal conditions, that means we're going to sell the later units, which are usually the more expensive units under normal conditions. And that means the cost of goods sold on the income statement will be higher than otherwise would be under first in, first out, which means net income will be lower. which means that it makes us look kind of worse. You know, why would we want to look worse? Maybe for taxes, right? So if you can use last in, first out for taxes to lower your income, then you might end up paying less taxes. It's a timing difference. It'll wash itself out over time, but that's one indication. But it also just gives us a good idea of the difference between the different flow assumptions and the effect they can have on the financials. So we're going to say, all right, we're going to assume we sold these first. So now I'm going to pick up the entire 1,200 this time, picking up the later row first, 1,200 times 12. And then I'm going to back into the current row. Now these ones, if we keep on making more units, that means that these units here will sit on the books forever. We'll never get back to them. You know, if we still make more units, we'll have these layers that'll be on the books, which again is kind of weird, but that's the way it would work, right? So we're going to assume that we didn't sell these, and we're going to say now we sold a total of the 1,800 minus the 1,200. So that means we sold 600 of the 780 in the the first layer, the primary layer, at the $10. So if we multiply this out, the 600 times the 10, there we have that. We're going to sum up these now, summing up, underline, home tab font group, underline. Let's sum up over here equals the sum of these two. Let's underline, home tab font group, underline. There's our cost of goods sold. Notice it's different for the FIFO and the LIFO. Then we'll say, well, what's left in ending inventory under LIFO, last in, first out? Well, now this beginning layer is still there because we're not going to get to the beginning layer unless we finish all the ones on top first. It's kind of like stocking the shelves where you put all the new stuff on top of the old stuff so that like the old stuff no one ever gets to it. So then this is going to be the 10. And then if you multiply this out, the 180 times the 10. And then we're going to be picking up the second column is going to be gone. The current items, so the 1,200 minus the 1,200, that's been wiped out. So that the later rows, or layers they're often called, have been wiped out. So if we sum up this, then equals the sum of the units and sum of the total. There we have it. Let's do an underline, home tab font group, underline. Let's underline this one, home tab font group, underline. So notice what our difference is. So they could ask us for the difference once again with the cost of goods sold or ending inventory. You need to know them both and be able to set up a worksheet that can calculate both of them. So that you're ready. You're ready for whatever's asked if you're looking for a test question type of scenario. So under normal conditions, rising prices here then, you would expect the cost of goods sold under the first in, first out to be less than the cost of goods sold for the last in, first out. Meaning, when you sell the units, you're assuming under a first in, first out method, you're selling the earlier units, which are usually, because of inflation, the cheaper ones. That means that you're going to be having a lower expense here than you would here. You would have then a higher net income. The expenses are lower, net income would be higher for the first in, first out. So first in, first out would typically make you look better, you would think, under normal conditions, under rising prices, than last in, first out. Why would you use last in, first out? When would you want to look worse? Possibly for taxes, because if you make less revenue, and you're basing your taxes on the taxable income, and you get to use LIFO, then maybe it'll be less. But then you think about what's going to be on the ending inventory, what's left in ending inventory on the balance sheet, the items we have not yet sold. Notice under first in, first out, under the assumption of rising prices, we would expect it to be higher than under last in, first out. And that's because the first in, first out, we're assuming that we sold the beginning or cheaper units, and therefore still have on hand the units that we produce later that are more expensive. So our assets are higher under the first in, first out. So notice first in, first out's making us look better, on both sides of the equation here, right? On the sales side, we have a higher net income because we have a lower cost of goods sold, and the assets we have are higher. And then under normal conditions, increasing prices. And then the ending inventory over here under last in, first out is going to be lower. Why? Because we assume that we sold the later ones, which are typically the more expensive ones, And therefore, we have the older ones that we're assuming are still the units on the balance sheet. Now, again, notice that the units are exactly the same. We're imagining all these units are basically the same type of thing, but the cost increased over time, and therefore we have to assign which units have which cost. Now, we could use another method, which would be an average method, which would kind of be in the middle of these two. So once again, I would memorize what happens under these two methods under rising prices, which you would want to think in your mind as normal conditions, and then flip that under lowering prices. In other words, if the unit price went down, if it it was cheaper to produce at later points, then you would then the outcome would be reversed, right? Then this number would be less than this number, and this number would be less than this number. So instead of thinking about like four things, I would think of the normal condition, inflation, rising prices, and then the opposite under decreasing prices, which would be more of the unusual condition.